Before we begin, make sure to subscribe to the channel and join our Telegram group where we discuss stock market insights, investment strategies, and answer your questions. The link is in the description. A stock might look cheap, but if the company is drowning in debt or struggling to generate cash, it could be a disaster waiting to happen. Even great businesses can go bankrupt if they mismanage their finances. That's why checking a company's financial health is crucial before investing. Today, we'll break down how to analyze a company's balance sheet, cash flow statement, and income statement to check if it's financially sound and built to survive tough times. By the end of this video, you'll know how to assess a company's stability, profitability, and cash position using key financial ratios, and more importantly, what these numbers actually mean in real-world terms. Every company releases three key financial statements that provide insights into its financial health. The balance sheet tells us what the company owns and what the company owes. The cash flow statement shows how much actual cash the company is generating. The income statement reveals how profitable the company is. These statements work together to give a complete picture of a company's financial standing. Think of it like your personal finances. Your bank account balance is like a balance sheet, showing your savings and any loans that you might owe. Your monthly salary and expenses function like an income statement, showing how much you earn versus how much you spend. Your cash on hand after expenses is like a cash flow statement, indicating whether you have enough liquidity to handle unexpected expenses. The balance sheet is a snapshot of a company's financial position at a given moment, listing assets, liabilities, and shareholder equity. Assets include cash, property, equipment, and inventory, things that the company owns. Liabilities are loans, supplier payments, and salaries, money that the company owes. A strong balance sheet means low debt, sufficient assets, and financial stability. The debt to equity ratio, or D/E ratio, helps us understand how much of a company's funding comes from debt versus shareholder funds. It is calculated as total debt divided by shareholder equity. If a company has too much debt, it becomes high risk because it must make large loan repayments even in downturns. A debt to equity ratio of 2 means that the company has twice as much debt as equity, making it vulnerable to rising interest rates. A low debt to equity ratio below 1 signals financial stability, while a high debt to equity ratio above 3 or 4 can indicate excessive leverage and financial distress. Another key metric is the current ratio, which measures whether the company can cover its short-term liabilities with its short-term assets. It is calculated as current assets divided by current liabilities. A current ratio below 1 means that a company may struggle to pay its bills on time, which is a red flag. A very high current ratio, such as above 3, might indicate inefficiency, meaning that the company is holding too much cash instead of reinvesting in growth. But even a company with a strong balance sheet can be in trouble if it is not generating enough cash. That's where the cash flow statement comes in. A company can report high profits on paper but still fail if it does not have enough actual cash to run operations. Operating cash flow, or OCF, tells us how much cash the company generates from its core business. If a company consistently has positive OCF, it means that the core operations are bringing in more cash than it spends. If OCF is negative for multiple years, then it's a warning sign. The company might be relying on loans or fundraising just to stay afloat. Another critical term is capital expenditure, or CAPEX, which is the money a company spends on buying or upgrading assets like factories, machinery, or technology. CAPEX is good if it leads to growth, but if a company is spending too much on CAPEX, more than what it is generating in operating cash flow, then it might be overextending itself. Free cash flow, calculated as operating cash flow minus capital expenditure, shows how much cash is left after covering expenses. If FCF is positive, the company has extra cash to expand, pay dividends, or reduce debt. If FCF is consistently negative, it may indicate that the company is burning cash too fast. The income statement tells us whether the company is profitable and growing. The net profit margin measures how much profit the company keeps after covering all expenses. A higher margin means that the company is more efficient at converting revenue into profit, while a low margin indicates it struggles to control costs. Two other key metrics are return on equity and return on capital employed, or ROE and ROCE. These measures are measuring how efficiently a company generates returns on the money invested by shareholders and lenders. High ROE and ROCE are signs of a strong, well-managed company, while declining ROE and ROCE suggest profitability is shrinking. Finally, revenue growth is essential because a company that isn't growing may eventually lose relevance. If revenue is consistently increasing, the company is expanding. If revenue is declining, it may be losing market share or struggling in its industry. Some red flags to watch out include high debt with falling profits, which signals financial distress. Consistently negative free cash flow means that the company might be burning through too much cash. Declining revenue and shrinking margins can indicate trouble ahead, and unusual accounting adjustments may be a sign of financial manipulation. Now you know how to check if a company is financially healthy using its balance sheet, cash flow statement, and income statement. But financial health alone is not enough. You also need to check if the company is generating high returns for the investors. In the next video, we'll analyze profitability and growth, how to identify companies that consistently generate strong returns. If you found this useful, hit the like button, subscribe, and turn on notifications so you don't miss the next video. Also, join our Telegram group where we continue these discussions and share valuable insights. The link is in the description. See you in the next one.